So much, Mr. Uche. Good morning, everyone. Good morning, Mr. Uche. Thank you so much for the opportunity once again. Mr. Uche has basically given us a brief summary of what the market is doing, what our expectations will be going forward in this class on how we can hedge with real gold. So before we can proceed with what's of how you can hedge with actual gold. I usually love to take people through the theoretical aspect of investing in gold, basically. So I want a case where this class is very interactive. This session, I love it to be to be a very interactive session, basically, because theory can be a bit lengthy, it can be cumbersome. So I want a case where it is actually very, very engaging. So just as Mr. Uche mentioned, we'll be expecting more people that will be joining us, but we can't wait for them. And so we just have to proceed. So I don't know if everyone can hear me. If you can hear me, you can just put on a chat box or you can unmute and just.
Yes, we can.
Okay, thank you so much. So before I proceed, I just want to ask a brief question. What we understand by maybe what gold is and what it means to hedge with real gold. If anyone has a basic understanding on what and those terms are, what is gold and what it means when they say you hedge with gold, before proceed to the class. Do you have anyone?
Hello, can you hear me?
Yes, I can hear you, Mr. Felix. Good morning, sir.
Good morning, sir. So, like we all know, gold is a precious metal that has value. We all know, I don't know how to define it, but I guess we all know what gold is. The
Yeah,
precious metal, the precious mineral that has value. And
beautiful.
by hedging, it simply means, will I call it like supporting your investment so that in case it's depreciating in value, you can use gold to wage it. So it's just like waging your investment with gold to ensure that your investment is preserved and does not diminish in value. That's my understanding of hedging.
Okay, thank you so much, Mr. Felix. At least that's just a brief explanation. I don't know if you have any other person with a different view.
From me, I can say maybe it's used to back up our investment in order to depreciate as well.
Beautiful. Beautiful. Backup. That's another keyword as well, backup. Okay, so I would just as Mr. Tochukwu and Mr. Felix have said, those are two valid points. Wedging our investment, more or less having a backup as well. So that is what it means to hedge gold. So moving on, so what I'll be focusing on, as is stated on the screen, we're looking at investing in real gold, which is holding gold and gold assets in your portfolio. So just like I mentioned, for us to, before we proceed to understanding what hedging of gold is, we need to understand the theoretical part of that's the underlying, the basics of what gold is. So we can all understand how gold came about, how we can all be part of this gold investment and have it in our portfolio. So we move on to understanding gold trading, where we understand that gold is one of the densest of all metals. It is more or less a good conductor of heat and electricity because gold is visually pleasing and workable. It does not tarnish or corrode, and it was one of the first metals to attract human attention. So just as Mr. Felix mentioned, we all know what gold is. It's a precious metal. It's one of the it's a very good conductor of electricity and just one of the first metals to attract human attraction rather. So if we look at what the introduction here basically is stating, it just means that the gold appeal has remained constant over the centuries, which it even transcends its aesthetics appeal to become a fundamental component of global financial markets. So it's known for its stability. It has actually played a pivotal role in economic history, serving as a hedge against inflation, using the word backup against inflation and currency fluctuations. So its enduring value continues to attract investors, providing a reliable store of wealth in turbulent economic times and an opportunity for growth in more stable periods. So we know some of its properties are longevity, pliability, and the fact that its imperviousness to rust, and it ensures that instead of being depleted, it tends to be amassed through time and safeguarding wealth for future heirs. So this is just another way of the word using the word backing up your investment with gold. So if we move on to tradable instruments or products that we have the physical gold bars, the gold futures contracts, the gold ETFs, equity investment in companies focused on exploration and mining. So the next slide, we'll talk about the physical gold bar. So basically what this means is the physical gold is a tangible asset often used as a hedge against inflation and currency fluctuations. So the physical gold, you can invest in terms of investing, having gold in your portfolio, you can choose to own the physical gold itself. That's the physical gold bar. It could be in form of a gold bar. It could be in form of a coin. It could be in form of a jewelry or anything that you can actually see or hold gold, basically. So that is you investing in that space. So that is where the physical gold comes into play. So it can be purchased in form of bars, coins, and jewelry. So that means you can choose to say, okay, you want to purchase bars. You can choose to say you want to buy the coins or you want to buy jewelry. You have it. That's definitely a portfolio on its own. So even if you choose to trade it or you choose to sell it, it will have its own value. Its own inherent value. So this is one form of um, holding gold in your portfolio. So storage and insurance are important considerations for investors holding physical gold. So gold is something that attracts humans. So there are so many people in the area of insecurity as well, security wise. Once someone sees that you are in possession of a physical gold or something, of course, you are putting yourself at risk. So it's usually encouraged that storage and insurance are usually important considerations when you are holding this physical gold. So moving on to gold futures contract. So gold futures are standardized contracts to buy or sell a specific amount of gold at a future date and price. So to explain that further, so what the futures contract means basically is asset contracts which are bought at agreed price but delivered and paid for later. So let me give another example. Let's say Mr. A and Mr. B want to go into a futures contract. Mr. B wants to purchase gold from Mr. A, and the price given to Mr. A is 5,000 naira, for example, and the agreed date will be in the next 2 months. So even if that price increases to 15,000 or it reduces to 1,000, by the time in 3 months time or in 2 months time, the agreed price, which is 5,000 naira, is what will be paid. So that is what it simply means by the gold futures contract. So you are buying at an agreed price but delivered and paid for at a later date. So we agree on the price today. Even if the price changes tomorrow, we are still going to pay the same price, which is today. So that's the summary of gold futures contracts. So futures contracts allows investors to speculate on the price of gold or hedge against price changes. So you are more or less locking a price today. Whether the price changes or not, you are still sticking to the price that was locked in today. So moving on to gold ETFs, so which are exchange traded funds. So ETFs basically provides investors with exposure to gold by tracking the price changes of gold. So, and equally, it allows investors to profit from gold price changes without having to own the physical assets. So what ETFs basically mean, again, is the fact that if you don't have the capacity to own to own the entire moving on to looking at the physical gold or the futures contract, ETFs gives room for people to own a portion of gold. So I'll give an example. Let's say a gold bar is 100 grams and is going for, let me say, 10 million naira. If you don't have the capacity to buy an entire gold bar, an ETF comes into the picture where they can say, okay, you can own a portion, let me say 1 gram of that bar. And that 1 gram, it will now be, let me say, for example, let me say 50,000 naira. So indirectly, it's saying with 50,000 naira, you can own a portion of gold. And ETFs are equally traded on various platforms on the exchange platforms of GFT, just like what we are making use of here in Uche Paragon's trading school. So gold ETFs are investment funds traded on stock exchanges, more like stocks. So what that means, more like stocks? I mean, if we're all familiar with how the stock exchange works, we have companies that are listed on the stock exchange. Say, for example, GT. You can beat your chest and say, "Oh, I own a share with GT." That doesn't mean you own the entire GT bank. You just own a portion of GT. So if GT is doing well in the market, their valuation is going up, and by the time it's time to pay dividends and the likes, you get you at least would have made a bit of profit. So that's that's basically what ETFs mean. So you are just owning a portion of the total investment, the total instrument basically. So they hold gold bullion as a primary assets, which provides providing investors exposure to gold prices. So you still have access to the gold pricing. So even if you buy a portion at a given price, by the time the value in the market does very well, of course, you know that you are more or less, you've made a bit of profits on that investment, on that ETF portion you've purchased. So ETFs equally offer liquidity, lower transaction cost, and ease of ownership compared to physical gold. So just like I mentioned, imagine a gold bar or a gold coin is going for 10 million naira and you don't have the capacity for that. And with as little as 50,000 to 100,000, you can own a portion. So at least you still be an owner because all documentation will be provided. You will have all papers and all of that. So you can still beat your chest and say, yes, you are a certified owner of gold because of that portion, that you were able to invest in. So moving on to equity investment, another form of gold investment. Equity investment in companies focus on exploration. So investing in gold mining companies provides indirect exposure to gold prices. So what this means is you can choose to highlight companies that are involved in mining activities. You can choose to look them up and invest in these companies, just like you are investing in, let me say, a Dangote refinery, for example. If you feel that okay, this company has the tendency to do well in the market, you can equally invest in those companies. Companies that are focused on exploration and mining activities. So this is another avenue where you can even play a part in the gold space. So companies involved in exploration, mining, and production can benefit from rising gold prices. So if these companies that are focused on these mining activities, they go into the site and do the needful, and at the end of the day, by the time they turn around the gold that they have mined and they amass so much profit. Of course, you that invested in those companies will pay, and we definitely have we actually benefit from the proceeds that the company gets. So this type of investment carries additional risk related to company performance and market conditions. So this just means that if the company is not doing very well, if they are losing money or their market valuation is not so great, that's company performance and the likes, of course, your investment will drop. So giving an example of how the stock market works. So if a company is not doing so well, company performance, maybe there's internal crisis and all of that, of course, in the international space, the markets and that company's performance will drop, and that will lead to your investment also going down the drain. But it's this also another form of investing in gold as well. So the investment objective of holding gold. So the major investment objective of any gold investment is to provide investment results that before fees and expenses, which closely correspond to the performance of the LBMA gold price. Although there is never the guarantee of achieving 100% target of this objective. I want us to pay attention to the word guarantee. In any investment that has to do with, let me use the word in the capital market space or in the world of investments, there is no such thing as guarantee. Anybody that says, I guarantee you X amount of profit, that person just wants to take your money, because the market moves by the laws of demand and supply. So you should put it at the back of your mind that the market can fluctuate. So you don't expect that you must get a guaranteed return. That word is very risky. Most people tend to use the word, oh, I guarantee you 100% returns, which is, for me personally, it is wrong, because in the world of investing, there's nothing like guarantee, because you are more or less putting yourself on the line that I guarantee you. So which is absolutely wrong. So and just like I mentioned, the market moves by basically the laws of demand and supply. So, of course, just as when demand is high, and when the demand of something is high, of course, the price of things goes up. So, and when the supply is low, of course, we know what the repercussion is. So, laws and the laws of demand and supply plays a very key role. So, what is the investment strategy? Acquire and hold bullion or gold for the purpose of liquidity. Investments in gold assets will only be on regulated exchanges to efficiently manage risk. So, investment strategy. Why do people hold gold? Why do you want to have gold in your portfolio? For liquidity. Hedge against inflation, hedge against various things. And for you to have the rest of mind to be sure that your gold is well regulated, that is where platforms like the GFT Ava comes into play, and regulated exchanges come into the picture as well. Because there are so many investment people who come today and say, oh, bring X amount of money, I'll purchase this, purchase that. But if they are not regulated, then you are putting yourself at risk. GFT Ava has proven over time that you can have your investment, you can even play around the platform yourself. There's a platform there that you have your dashboard, you have access to what the pricing is doing. You can buy your gold yourself and all of that. It is regulated. It is not a Nigerian company, it is an international company backed up. So it is fully regulated. Or even if you want to go into the Nigerian space, there are regulated exchanges that are involved with this, regulated in the sense that they are regulated by SEC, that's the SEC, Securities and Exchange Commission Nigeria. So those are people that effectively manage risk. So either because we, on the other hand, most times people may say they want to deal with just Nigerian bodies or international bodies. So the good thing with the Uche Paragon Trading School, we are not just focused on the Nigerian market alone or the international market alone. We more or less position ourselves in the case where if we have international backing and we call it the Nigerian backing. We have Nigerian institutions that we partner with to ensure that everything runs smoothly, and we have international organizations that we have and that we're in partnership with, that we ensure everything runs smoothly. So this is just a strategy that we use to encourage every persons we are tutoring on this platform. So we'll move on to custodial service. So trading gold, bullion, or coin must be supported by a robust vaulting and physical delivery infrastructure. All gold deposited and safely kept at an accredited vault registered by the exchange. So what this means basically is if you must hold, let me say the physical gold now, or whichever, any gold investments, we usually have an avenue where physical delivery and a robust vaulting service are in place, because you wouldn't want a case where you invest in gold and your gold, you hear that someone is just moving around with your gold from point A to point B. But the moment you hear that, okay, the gold you invested in is stocked up in a vault, somewhere safe, that's a good storage, which is registered by at least a good vaulting partner or with an exchange and all, at least you have a rest of mind that your gold investment is safe. So this is where custodial service comes into the picture. So we ensure that at every given time, all gold investments are safe. And all you just need to do is anytime you wish to access your gold, of course, you can put making all the necessary, you can put in all the necessary requests and you can have access to it. So before I move on, I want to just confirm if we are all on the same page, if we understand if we're all in sync, if you understand all that I've been saying so far.
Gradually, sir.
Okay, so just in case if of course at the end of the class there'll be room for questions and answers, but like I mentioned, I want it to be an interactive session. So if you have anything you can put on the chat box, I will definitely take a pause to respond to that. Okay, so allocated gold. So all bullion or coin deposited with the custodian must be held on a fully allocated basis. So what this means is that the investor will have an account with the custodian in the trustee's name, which will evidence that uniquely identifiable pieces of bullion or coin are allocated to the investors and are physically segregated in the custodian's secure vault from precious metals, including gold. So let's look at it on two ways. GFT Ava, like I mentioned earlier, you have access to your portal, your dashboard. You can see everything there. If you want, once you register, once you've done all KYC registrations, let me just use the example of your bank app. You know that by the time your bank you've opened a bank account, you have access to it on your mobile app. You can make a transfer, you can do whatever you want to do on the bank app. It is safe and secured. Your money is safe. So if you want to withdraw, you can choose to go to the bank itself to withdraw, or if you want to make a transfer, you can do the transfer. So that's just a similar thing with GFT Ava. So you have access to everything on GFT Ava. So you know that even if you want to request, you have all documents there, all the KYC documents, all the certificates that you own, and you are a certified owner of a certain of this gold or this investment. So it's not a case where you need to start rushing to the exchange or anything or anywhere else searching for where's my gold, where is my this, or you don't even need to be moving around with the physical paper. Because once you have access to your dashboard, to your portal, you know that everything there is intact and it is backed up. Or you can choose to, that's moving on to the Nigerian market. We have partners that are brokers as well. So thankfully, one of our key partners have started and they've digitalized their platform that you can have you have your own platform where you can see your gold portfolio. You can see various portfolios of what the market is doing and what you have in your portfolio basically. Unlike in the past where if you want to access your broker, you have to start maybe either sending an email or you have to go there with the physical paper and all of that. So now everything now is not digitalized. So in terms of evidence that you have X amount of coin or gold bars or anything, if you have everything documented virtually, basically. So basically, just like I mentioned, the trust has full title to all bullion held in its name with the custodian. So the custodian, almost all these things are just more or less big grammar. So like I mentioned, you have access to the portal, you can see what is there, you can make your transfer, you can make your purchase and all of that. So that way you are in safe hands. So moving on to the gold supply chain. How do we get gold into the markets? That's when gold is out there for sale of. So how can you access it? So first on the list will be the miner and recycler. So I'll just give a scenario as I'm going through this supply chain. Miner and recycler. A time in 2021, no, 2022, sorry. Gold was this is a real life scenario when the first gold coin was launched in Nigeria. That was in 2022. That gold was gotten from the miner, which was in Osun State. It was moved to the refinery. The refinery will request for the necessary documentation of that gold. Even if you don't provide those documents, the refinery have all the resources to determine where this gold was gotten from. If the gold is gotten from Ghana, if it is gotten from Nigeria, the refinery have all those documents, and there's a way they test to know where the gold is coming from. So you cannot pick up a gold from Nigeria and claim it came from Ghana. No, we are more or less engaging yourself in a fraudulent case. So moving on from Osun State, the gold moved to the refinery, then minting. In the case of minting, it will now be, how do you want the gold to be? Do you want it to be in the form of a coin? Do you want it to be in the form of a bar? Do you want it to be in the form of a jewelry? They mint it. Do you want it to be inscribed with, okay, maybe XYZ company, or how, or whatever? That's where the minting comes into play. Then it now moves on to the transport and logistics. So moving it down to, of course, moving it down to wherever the wholesaler is. That's where wholesaler comes in the picture. Wholesaler can now be the exchange, can now be and the Uche Paragon Trading Academy, which is the JFT platform. That's where wholesaler comes into the picture. Then moving on to brokerage. The brokers are the ones that will now demystify to look at, and or look at all the costs, look at all the costing. What did it cost to purchase from the miner, the refinery, the minting, the transport, the wholesaler? So brokers will determine all of that and look at how it will be suitable in the market. Okay, if we do it this way, with the market buying into this investment? So the brokers are the ones that look at everything and say, okay, this thing is good for the market and it is good to go. Next up, you wouldn't want the gold to just be the brokers or to just be lying there. Next up would be, it goes into the bank, the vault, the depository. That is where it stays. And after that, it is open to retail investors. The retail investors like you and I, that, okay, it is now the role of the brokers to now sound the alarm that, okay, we have this gold going for X amount of money. Then marketing starts. Retail investors come and purchase this. You can either purchase a full disc or you can purchase an ETF and all of that. That is where this is just a brief of what the gold supply chain is. It's just what it is. So moving on to gold trading itself. More than a century ago, the first precious metals benchmark was created. The fixing process involved a group of bankers sitting in a room haggling over the price of gold and silver. When demand matched with the supply, the fixing price was set. So back in the days, that's how gold trading was done. People just sit down, they just keep on running through numbers to see what the market will be comfortable with, and that's how the price is set. But in recent times, LBMA has come into the picture. So LBMA meaning the London Bullion Market Association. So those are the things that then that's an association that more or less it's an international trade association that represents the London market for gold and silver bullion. So with a global client base. So it includes more or less, it includes the majority of the gold holding central banks, private sector investors, mining companies, producers, refiners, and the fabricators. So that's basically LBMA. So these are the ones that now the global gold market is being backed by the LBMA. So if you're looking for any gold that is being sold anywhere, they get their global pricing benchmark from the LBMA. So that is what over the years LBMA has come to do in the market. So global benchmarks that administer the price of gold. So gold fixing price benchmark. So it was established in 1919, sorry. The price is set in London twice a day and provides a published benchmark price for gold that is widely used as an international pricing medium by producers, consumers, investors, and central banks. So auction by founding members are done in roundtables and later moved to secure telephone lines. But now, appointed 2015 as the new administrator of the LBMA gold price, that is Intercontinental Exchange Benchmark Administration, IBA, auctions are managed in real time with the modern technology. So now, this is not a case where people are just running numbers in roundtables. So now, producers, the investment community, banks and central banks, fabricators, jewelers, and other consumers, as well as market participants from around the globe, transact during the IBA gold and silver auctions and use the benchmarks as reference prices. So with modern technology, most of these prices are now done in real time. So it's now dealing with demand and supply. So that's what will determine what the price is doing in the markets. So fundamentals influencing gold price. So we're looking at the global fundamentals. So demand. Under a demand part, we have manufacturers, which is the jewelry, electronic and medical appliances, government and central banks, investment demand, that's investment demand, ETF spots under the central banks and government reserve holding. So these are global fundamentals that influence gold price. That's under the demand part. Under the supply, we have mining capacity of producing nations, release of held gold. Then we have currency inflation, we have interest rate, we have geopolitical factors. So these global factors are more explanatory. So we'll move to the local fundamentals of and that influences price of goods. So we have the international prices, international factors rather. The international spot price of gold is a determinant deciding the metal value of gold. So the spot price is decided in the London bullion market. If due to certain conditions, the spot price rises, of course, the cost of gold will also rise and vice versa. So international factors plays a very key role in the price of gold because despite the fact that gold is gotten from Nigeria, but then, just like I mentioned, every gold in the world is being pricing is being administered using what the LBMA benchmarks are doing. So if due to certain conditions, the spot price rises, the cost of gold also rises. So looking at demand and supply, the prices of all commodities in an economy are ruled by the laws of demand and supply, and gold itself is not an exception. So like I mentioned, when the demand for gold rises, the price will rise as well. So it's not rocket science. So demand and supply plays a very important role as well. So if we're looking at inflation as well, inflation, where we mentioned gold being used as a hedge against inflation. So when inflation rises, people tend to buy more gold for security, thereby driving up the price. Just as Mr. Tochukwu mentioned, a backup. So when there's inflation, people rush to buy gold more or less to hedge it against inflation. Higher conversion rate and hence a higher price. So using gold to hedge is another determinant again towards using gold, and that influences the local price of gold and that fundamental. So we have the exchange rate as well. So the spot price of gold valued in American dollars, euros, and pounds. Hence, the value of the Nigerian naira against this currency influences the price of gold. So when the naira drops, of course, the exchange rate is higher and a higher gold price. So gold is not backed by naira. So we have gold is being backed by the dollar, the pounds, and the euros. Those are the major currencies that gold is being backed. So when there is a drop in the naira, of course, the price of gold will go up. So that's why most times, most governments, especially Nigerian government, sometimes they hedge the naira against using gold to hedge, because by the time there's a fluctuation of the naira, of course, gold price goes up. So they use that as reserve holdings. So administrative and production costs. So that's where you find out that fabrication, refining, minting, numismatic value, transaction costs, taxes, and import duty. So this, by the time all these costs are being put into gold, you may purchase a gold, and you may purchase gold at 1 naira, for example. But by the time you do all of this, you add all of these costs, it will rev up the price of gold in the market. So this is another factor that determines the price of gold as well. So for now, the physical, and let me make use of the word, the physical local gold vendors that we have here in Nigeria. Why I said physical local gold vendors is because these are the physical guys that we have currently. While, like I said, local gold vendors, the physical local gold vendors. So we have the Lagos Commodities and Futures Exchange, the Kian Smith Trade and Co, and the IAC Gold. Then if we're looking at on-site gold vendors, that's now where GFT comes into the play. Despite the fact that GFT is not a Nigerian company, it's more or less a Nigerian company. Why do I say that? Because we have partnerships with these local gold vendors here in Nigeria. So why we created those partnerships to ensure that GFT can equally play a role and to boost investors' confidence that all their investments are safe. So GFT is not an by an international company, but we have partnership with Nigerian gold vendors. So which is why I said these are just local gold vendors, while GFT plays a role both in the local space and the international space. So earlier when I mentioned that the gold I was gotten from Osun State, it was as a result of coming about and bringing about the Echo Gold coin. This coin was launched in 2022 by the Lagos Commodities and Futures Exchange. The coin was, and the gold itself was gotten from Osun State, mined, and it was taken to the refinery. It was minted. So it now came about, and this was how the coin came out to be. So the Echo Gold coin is 50 grams in weight, 40 millimeters in diameter, and purity of 24 karat. So the coin came in 3 different unique features. One of the coin is it was minted with the arrow metal, which is the popular statue of the white cap chiefs in Lagos. The second coin has inscription of the Lekki Ikoyi link bridge, and the third one has representation of various commodities that can be traded. So the Echo Gold coin is currently listed on LCFA. So you can, through our partners here, through GFC, we can assist you in purchasing either of that and purchasing this gold coin, and even through the GFT platform. So we can equally assist you in purchasing physical gold bars. So this is just a brief of what I mean by at least a physical gold coin. So when this coin was launched in 2022, a full coin was going for about 2.5 million. But then we realized that not everyone will be able to purchase that, will have the capacity to purchase that. So that is now where ETFs came into the picture. The 50-gram coin was now dematerialized, and you could buy as little as 1 gram. And 1 gram then was going for about 43,000. In recent times, last I checked the platform of the LCFE. 1 gram is currently going for, I think it's 8,900. Let me just say approximately 89,000 per gram. So that is what, let's say you purchased 1 gram for 3,000. Now 1 gram is now going for 89,000 approximately. So that is what ETFs do. ETFs will still give you the opportunity to have an ownership in a coin. So Just this is just a brief of how the gold movement is. Okay, so just like I mentioned, anyone that guarantees that by the time you purchase gold, you get 100% profit at the at the onset, that person is just trying to um, take money from you without doing the actual thing. So if we look at this gold movement, there are times when, of course, the market is bullish, and there are times when it's bearish. So it keeps going up and down. But if we look at this trend, and you can see that the gold market and gold investment are actually good enough, because looking at the bearish part of it, it doesn't have enough significance compared to the bullish part of it, where it keeps going up and up. So gold trading strategies. So we have the trend trading, the range trading. So what this trend means is that everyone is important that as someone that wants to get engaged in gold trading or trading in general, you have to have your own specific strategy. My strategy may work for me, but it may not work for you. Your strategy may work for you and may not work for me. So what that basically means, everyone must have their own strategy, which means that you must understand the market by yourself. We are here to guide you on the basics. Uche Paragon Trading School, we're here to guide you on the basics on how the market should move. But it's now your duty to still go back to the drawing board, do your own assignment, and understand the market for yourself to make well-informed decisions. Because my strategy may not work for you. I may understand how my own strategy will work for me, when to go into the market and when to pull out from the markets. But that may not be the case for you. So trend trading basically is just the strategy of trend following is comparable to navigating the markets with. It necessitates a sharp ability to detect whether the trends are moving toward higher prices, higher gold prices, or receding towards lesser amounts. So we have the range trading. So within the fluctuating gold market, there are intervals during which the price trends horizontally locked within a specified bracket. So this flourish in these times, specializing in purchasing at support levels, a point where prices increases and offloading at resistance level, the junctures where prices tend to decline. So this is more or less like this previous charts here. So it's range. So you're looking at the pricing, you're looking past and looking at historical data to well inform your decision on how the range has been. So if you look at the trend that, okay, at so period, the market is good, at this time, at this period it's down. So you know when to go into the market and when to go out of the market. So that's where range trading comes into the picture. Okay, so I'm looking at breakout trading. So breakout trading is an approach for those eager to exploit the momentum of major market shifts. So it involves detecting and taking advantage of occasions when gold prices rupture past defined boundaries. So this is more or less, you are eager to exploit momentum. You want to know when. So this is just when to know when to pull out of the market. So because the breakout trading is after you have understood the market for yourself, you know when there's a bullish rise or there's a bearish decline. So if you are not conversant with the market, you wouldn't know when when the market is bullish or is bearish. So you need to understand, and there are certain terms that you need to understand in the markets. Because like bullish means, of course, when the market is doing so well, and bearish when the market is red. Let me use that word. So bullish, the market is doing so well. Bearish is doing the market isn't so great. So when I say we can only guide you, why you need to understand the market for yourself. You need to know what strategy to use. You need to know what strategy to use so that you'll be able to make well-informed decision and during trading. So you have the news trading as well. So those who engage in news trading within the global market relish keeping their fingers on the pulse of breaking events. So of course, news. You need to stay informed with the news outlets, because when there is a potential risk, or let me say crisis, in a certain area, you tend to realize that of course that will affect the price of market. In the case of, let's say, war or something, so you need to be well informed with news outlets, know what is going on and what is going on in a particular place. So that way you'll be able to make a well-informed decision with your investment. Okay, so we have the swing trading, we have the position trading. So swing trading appeals to the strategy's intent on harnessing the market's oscillations for gain. So this approach focuses on seizing short to medium-term opportunities arising from price fluctuations, usually within an established market trajectory. Position trading is akin to a marathon. So if you want a long-term play in investing, you need to understand that you need to position yourself, that you are not just there for the quick returns. You are there to play a long-term, you have a long-term goal for you to position yourself in the trading space or in the investment space. So some risks associated with gold trading. So some of them are gold price unpredictable fluctuations, high transaction fees associated with physical gold assets, influences from regulatory measures or policies, and over leveraging. So these are just some of the risks that are associated with gold trading, because traders need to do more. Traders more or less need to remain aware of several threats that could impact their investments in an adverse way. So if you feel that okay, you have gold in your portfolio, then nothing will go wrong. Then I think you just need to double check and be sure that you more or less just need to stay well informed of the risk, because in every business, in every investment, you need to position your mind that there are certain risks involved. So what now comes in the picture is, how do you then mitigate this risk? That's what now makes your investment safe and secure. So you need to understand this risk, um, um, monitor this risk, more or less study these risks and how to mitigate, and you now think of ways to mitigate this risk. So moving on to asset management now. So this is where I will regard and I'll refer to the GFT, rather the Uchi Paragon Trading School, as an asset management company, because like I mentioned, we are here to guide you. We are here to teach the basics. We are here to put you through. So we are here to help you manage your portfolio. So understanding asset management, it starts with defining the word assets. The word assets. So in the broad sense of it, okay, so I'll just give just a brief of this, then we'll just move on to the actual platform, the GFT ABA platform. So there's a broad sense of this. So basically, what is defining the word asset? So in the broadest sense, an asset is anything that delivers value to its owner and the stakeholders it serves. So this is just basic the brief explanation on asset management. So let me take you through the platform. So this is my platform. That's GFT ABA platform. This is the dashboard I mentioned to you that you have access to. It's not a difficult thing to access, to get to register. So okay, sorry, let me share this. Entire screen. Yes. Okay, sorry. Yes. Okay. I don't know if you can all see this my dashboard. So this is the GFT AVA derivative token. So this is my dashboard that I am currently running. So just to give a brief brief on GFT. So GFT is more or less designed for private individuals, asset management companies. So accounts are heavily regulated. So why GFT? It is a fully automated trading platform and is hybrid. Heavily regulated, you have access to liquidity, secure deposit and withdrawal process. So if we're looking at the full meaning of GFT, it means global financial trading, GFT. That's what GFT means. So GFT Ava, like I mentioned, is an international brand that is under Ava Trade. So you can also do your research on that, and you can understand why GFT Ava is very important. So so let me just put you through. Let's say you want to buy tokens. You want to buy tokens. So you come under this part to buy tokens. So let me quickly log in just a minute. Okay. So this is, if you want, let's say you want to buy about 10,000. I just purchased that this morning, 5,000 amounts in USD. Then it will give you the amount of GFT token, which is 22,720. So then once you click on buy, so it has various options. So you can, it has 3 months, 6 months, 12 months. So you can hold you can hold your investment for long term, 6 months, 12 months. So you don't need to be scared that your investment will go down the drain. So this is more or less me encouraging people to have a long-term investment and duration, that's maturity. So you can do 3, 6 months, 12 months. And once you click on that, of course, there are various modes of payment: crypto, Nigerian card payment, or USD card payment. And so moving back to my dashboard now, this is my total value in dollars, 5,000, 20 gram in gold holding, and the gold value is 1,960. So when the market is down, the price of gold goes up. So when the market is down, definitely the price of gold will go up. And the importance of clients trading through the company, there are so much importance of clients trading through the company, which is GFT. Because just like I mentioned earlier, this is my dashboard. You can sit down behind your system, your phone, and you can do this all by yourself without, it's like I mentioned, it's heavily regulated. You have access to financing. Um, you have access to financing. You have you have secure deposits and withdrawal process. So you have access to liquidity. So it is fully it's also fully automated. So this is, you don't need to start moving around with paper. By the time you do your account verification, you do the needful, you have all KYC documents, you have access to this, provided you have your email, your login details. So this is what the GFT Ava platform does. So like I mentioned, even with this platform now, with this platform, you can even have your own account and hedge on GFT Ava, or use their automated trading platform such as MAM. So while this company will hedge directly, so why the company rather hedges directly. So you can use this platform, you can own your own accounts and hedge on GFT Ava. So this is, you using this platform, you have your own accounts. You can use this to hedge with gold using this GFT Ava. So just like I mentioned, you have access to your platform provided you have your login details. Provided you have your login details, you have access to to any trade. So you more or less even be trading with the same brokers GFT Ava makes. GFT Ava also makes their own trade. So you'll be trading the same way other brokers are trading as well on other platforms. You as well will be trading using your own GFT Ava accounts. And that way you know that all your trades are safe and secure. So the GFT Ava platform has come to even make things easy. So let's even take, for example, you can deposit $1,000 on MT5 and hedge 30% of it on real gold. So let me put that. Let me say that again. You can deposit $1,000 on MT5 and hedge 30% of it on real gold. 30% of 1,000 should be about $300. So you can hedge 30% on real gold. So while you use the 70% to do other things. So and this real gold can come from another exchange. So you can choose to say, okay, this 30% you want to use it to trade on another exchange. Let me say, for example, and the LCF, Lagos Commercial Futures Exchange. You can use that 30% to trade real gold on another exchange to more or less have a diversified portfolio. Yeah. So just to repeat it again, this platform is safe and secure. It is designed for private individuals, asset management companies. The accounts on GFT Ava are heavily regulated. YGFT, fully automated trading platform, heavily regulated, access to liquidity. It is secure deposit and withdrawal process. So with strategy trading, gold value will be rising and their derivatives trading will be rising as well. So let me take that again. So with strategy trading, gold value will be rising and their derivatives trading will be rising as well. And on a high risk market, they can swap back. So when there's a high risk market, you can swap your portfolio back. So this is more or less a brief of our class of what we'll be focusing on today. GFT Ava, investing in gold, holding gold in your portfolio, and hedging gold, hedging with real gold, rather hedging with real gold. So I'll round up the class now, and I'll leave the floor open for questions and answers. Thank you, everyone. So if you have any questions, you can unmute and throw your questions in so we can respond to them.
Mr. Manasi.
Yes, Mr. Felix.
Yeah, thank you very much for your presentation.
Thank you,
my
sir.
question
Hello, sir.
is as a trader on the factors that influence. Can you hear me?
Come again. I can't hear you. I'm breaking.
Hello, can you
Okay,
hear me,
I can hear you now.
Can you hear me now?
Yeah, I can hear you.
Okay. I said as a trader, as a retail trader, considering
Yes.
the factors that influence the price of gold, like you mentioned, demand, supply, currency, inflation, interest rates. Now,
Yes.
because this gold is being traded on the exchange and on different countries, interest rates are you going to be considering, knowing the fact that interest rates varies from country to country? So which country's interest rates will affect this gold, assuming I want to consider interest rates as a factor?
Okay.
I don't know if you
So
understand my question.
yes, I understand. So the country's interest rate you'll be focusing on will be the United dollars, United States dollars, US dollars. Can you hear me, Mr. Felix?
Okay.
Yes, the US dollars. Because we're looking at international trade all over the world. Almost everything, or if not everything, is usually being considered using the US dollar. So we'll make use of the US dollar because it is valued and gold is valued in US dollars.
Okay. So thank you very much for that. So factors like demand and supply, how do you have an insight into the demand and supply level of gold to predict price?
So let's look at when a USD falls, whereas when the US dollar falls, gold rise. So less demand on USD, is low. So gold rise. So when there's less demand on the United States dollar, gold will rise. But when USD fall, gold will also rise. So also mining demand, that's mining factor of it. You know, when there's a slow in mining activities, of course, that can also affect the prices as well. So and there are so many factors. Like I mentioned, when USD falls, gold will rise. When with less demand on USD is low, gold will rise. Then you're also looking at geopolitical factors as well. When there is a crisis, war, insecurity, and the likes, it will definitely affect um, the prices. You can look at what the Ukraine-Russia war has done, even the Israel and Gaza war too has caused as well. It will affect it will cause the gold to rise. So these are just some factors as well. So that's why I mentioned geopolitical factors in the course of my presentation. So I don't know if that answers your question, sir.
Absolutely. Thanks.
You're welcome, sir. Okay. Do we have any more questions? Questions. Questions. Okay, Mr. Oscar. Yes, please. You can unmute and ask your question, sir.
Well, thank you so much for the wonderful presentation. My question is about like the market correlations. What happens in terms of those countries that import gold? Meaning when they are importing gold, meaning the gold will be rising, it will have a very good movement. Now, what happens in the situation where those countries which are importing gold stops to import gold because of some geopolitical factors or anything that can make gold to be on hold? Does that give risk to the money that we invest in gold as a hedging tool?
Okay, yes. So what we do is our major focus, just like I mentioned, if you remember, in the course of the class. So what we focus on regulated and monitored markets. We don't just invest in every gold. So our focus is on regulated and monitored markets. So once there's a regulation, once there's a regulation, at least we know that the impact wouldn't be so much. So if those countries are part of regulated channels, of course it will affect the price. So we focus on regulated and monitored markets. So, but if those countries are part of regulated channels, of course it will affect the price. So that doesn't mean, just like we mentioned, geopolitical factors are things that will definitely affect every commodity. So if a country or so is even under a regulated and monitored market, of course, to affect the price. So it's just a factor that may affect various prices there. So, but one thing we focus on regulated and monitored prices. Sir. Hello, Mr. Oscar.
Hello? Okay, so like there is how is it in terms of the risk exposure, the money that we put in, let's say 30% of $1,000. How is the risk exposure when the markets are so bad in the gold market? Meaning it takes maybe 3 months, the whole gold market is not good.
Okay, the spot market is low risk. Spot market is low risk. That's one thing at least we can say that the spot market is low risk because in 1 year now, gold has gone 100% in 1 year. So despite because of the fact that regulated and monitored markets, people know when to how to go around the markets. Because in 1 year now, gold went from, I think, from about $39 to $101. So the spot market is highly low risk, not zero risk, low risk. So there are still some risk, but it is low risk. So which is why you see that in 1 year alone, gold has gone from $39 to $101. Yes. So
All right.
spot market is not also done on margin or leverage. So, yes.
All right. Thank you, sir. It's
So thank you,
clear
sir.
now.
Okay, thank you, sir. So I think we'll more or less be rounding up because Mr. Uche Paragon is supposed to take us through the practical session. So we usually have two sessions, the practical and the theoretical parts. So Mr. Uche will be taking us through the practical session of today's class. So thank you so much, everyone, for joining in and for listening. And just like I mentioned, we are always here to guide, put you through the basics, and to ensure that you're not left alone in adding gold to your portfolio and various investment portfolios. So thank you so much. Mr. Uche, over to you, sir.
Hi, can you hear me?
Yes, we can hear you loud and clear, sir. Welcome, sir.
Okay, perfect. I hope we all got value from the class.
A lot of value, sir.
Okay, so we will go into practical aspect of it. Now, then we will analyze other stuff. So while we go in, please, I will want you to use my referral link to sign up for now, because I have a target I want to achieve in terms of marketing. Please, this is for education and research purposes. So just sign up to see how the interface works and everything. Because one good thing about it is this, let me tell you, just as you mentioned, you as a trader, you can trade through the company and of course, we use only regulated companies. Managing your own account and hedging it with gold, because we are here to make sure your safeguarding is more important to us, where we don't want any of our students to be crying like others in the market that I blow my account, I don't blow my account. Now, let me ask a question, and let me get a feedback from you. Please be sincere, all of us. With this kind of model, how possible is it to blow account or to liquidate account in the market? Do you think it's possible?
You mean trading CFD on a metaphor or something?
No, with the model of hedging with gold, whether you're trading on CFD or futures or stock, and you have the system that hedge with physical gold. Do you understand? Because we are bringing you guys to the realm of where those institutional traders, how they do it their own. They could do our own on the retail level where we have access to as well. For example, now we are giving you access to hedge or gold. Now, do you think it's possible if you implement this kind of process? How possible have you seen it that you can still blow your account to zero? Is it possible?
It's not possible, sir, because the emotions to that investment are detached. Unlike when we are trading on the real charts, whereby time after time you'll be looking at the charts, the emotions will be so high, such that you can blow the account very fast.
One is a good feedback. Which other person have you seen another possibility? Who else? Cynthia, did you see any possibility of blowing account with this kind of structure?
Yes, sir, sure. I'm still trying to find my way around it because I wasn't in class when you started talking about it. So, but with time, I'll get used to it. Sure.
Okay, but try to sign up on that link and see everything. We're talking about when you are when you are on trade and part of your trade is hedge with a physical good on another market or another exchange. So whether it's possible, whether there's also a possibility of waking up and you blow your account. You know, people that trade on online market, they always have that in common these days. the young generation, I blow my account, stuff like that. So, Felix, did you see any possibility of blowing account?
I see a possibility if risk is not managed well.
Okay, on the gold channel.
Not on the gold, on your normal trading platform. So even if you hedge with gold, for instance, and then while trading your normal MT4, if you don't manage risk well, I think you can still blow it.
No, because of part of your money is already hedged on physical gold.
Yes.
So that means even if you have magic call on your marginal account, the gold value is still there.
Anyway, I've not heard of this system, Sha. It's strange to me, Sha. It's strange to me, but it's
both of you,
it's
or let me just hear you guys' opinion, because you have to be critical, you have to try to understand something. Do you see the possibility of waking up maybe at $1,000, you have lost it to zero, the way it happens? For me, I can't hear him, probably he's busy. For him, I'm not seeing possibility of blowing account again in the market because of the hedging parameter. And when I say blowing account, like people that liquidate their account to zero. So possibility is very, very, very much minimal. Do you understand? So possibility is very much minimal. Now, but I want to share another thing with us. But very quick, before we go into, I will use 10 minutes to share it before we go into practical analysis. Now, what I want to share with you is this. I mean, practical, please just be sensitive so that you can grab something. If you're not sensitive, you won't be able to grab anything. Yeah. I hope you can see my screen, right?
Yes, sir.
So being critical is this. I was critical about the whole system. I was asking which particular currency, how do we implement it practically in trading? So I began to make it more research, although I've done that research last year. But I just have to give grab some notes to let us know how we can trade it, how we can be able to mirror the strategy, even if you're using a GFT Alpha platform. Do you understand? How you can mirror it? Then I try to find out those instruments that goes in opposite correlation with gold. Do you understand? So one of the ways you can know you can be able to trade professionally and profitable and on proper risk management is to trade on gold with opposite correlation of asset. Now, one of the assets that I discovered is dollar index or US dollar. Now, let us pay attention very clearly. You know that the US dollar and gold is paired. So they said when US dollar strengthens, so gold price will fall, right? And it's vice versa. So if the dollar value is high, this will fall. Now, take note, in the market, it's only US dollar and euro that's available, or dollar and gold. Or, I mean, dollar is not single. Dollar is always paired with something. Now, it means here, I'm not sure if I can finish this presentation in the next 10 minutes. But if you guys are not bored, anyway. But if you come to chart here, I hope you can see my chart. So it means that if euro US is rising, it means dollar will be weak. If euro US is rising, so dollar will be weak. Do you understand? So technically, when we are buying euro, automatically the value of gold will tend to rise. Because of when euro US is rising, it means dollar is going weak and the gold price will be appreciating more. Even the one you are holding on exchange, like the one you are hedging, the price will be rising. So let's say you want to change the entire strategy of technically be hedging with gold. Now, you may consider more of making more profit with using using buying position on Euro USD, for example, it means that if I place a buy here and the price of gold is right, and the price of Euro USD is rising and giving me profit, it means the price of gold I'm also holding here is possibly going to rise. The price of gold I'm holding here on my spot is possibly going to be rising. Now, if it comes down, like the price come down here, like the market start going down, which is what we call losing trend. Which is called losing trend, or your trend trying to hit stop loss. It is already hedged on gold. Let's say you just want to be maintaining your gold hedging, like one currency and one instrument against another, against a hedging asset. So if the price of Euro USD started falling, which is a bad market, then the gold price will rise.
Sorry, I thought you just said when Euro USD is buying, gold buys.
No,
and when
no.
Euro USD sells, gold buys again.
Sorry. Let me correct myself clearly. When dollar is rising, the gold price will fall, right? Yes, when dollar is rising, gold price will fall. So when dollar price is falling, gold price will rise. I think, yeah, vice versa.
Yeah, okay.
Yeah. So now, if Euro USD is rising, it means dollar price will be falling and gold price will rise. Do you understand? If Euro USD is rising, it means dollar is obviously weak, and it will strengthen gold as well. But if Euro USD is falling, it means dollar is gaining strength and gold price will most likely going to fall. But not in all the cases. Let's say now we are hedging together with Euro USD and gold. Now it means that when we place a buy on Euro USD and it started going up, it shows a weak dollar and a strong gold. Do you understand now? So if the price is falling, it will show a strong dollar and a weak gold. So vice versa. So on this note, it can be very much easy for you to mirror the particular position you can take on your gold. I know the best time to buy the gold or to swap from your derivative to gold. And with this system, it can be difficult for you to have liquidation. I don't know if I'm sounding a bit technical.
Break it down a bit, sir.
It's a little bit. Let me. So if, for instance, you have this system in place where you hedge your trade with real gold. Now, for instance, now on Euro USD, you enter a buy position. So invariably, gold in that case will be buying too. No, gold will be buying, Abi.
Say that again.
Okay, so assuming you have this system in place, then on Euro USD, you enter a buy trade, for instance. Now you're now making money here because of buy you enter. Then you now go on gold. So that means that gold will also be buying.
Yes, because of dollar will be weak.
So okay, so that means in this system now, that means you are making money from two places.
Yes. With the same money. Yes.
Oh, that's interesting.
That's why the essence of this is to help show you how you can begin to apply it. Do you understand? So that's why when you are in any class, always ask yourself, what is the essence of this thing? How will I make use of this? Do you understand? But if you don't know how to make use of it, you just on information purposes, then
Please, sir, can you come again with this last point that Felix had said, please? Could you come again?
Now, Felix understood that if Euro USD is buying, like the price of Euro and dollar is rising, so obviously dollar is going weak. And when dollar is weak, gold will rise. So when we see that dollar, Euro USD is rising, technically the price of gold we are holding here will also be rising automatically.
Yeah, true.
So now, if Euro USD is falling, of course, it's a sign that
okay, I get that now. Like when the dollar is weak, the price of gold will be strong.
Will be strong, yeah. So you see how big investors hedge. Listen, I'm trying to tell you how the big company hedge their listen. That's why anytime there's crisis, you see that gold will always rise. So they may technically follow the correlation of gold and the asset class that is matched with gold. So on trading, when we have a very low price of Euro and Euro USD, then we should also be strategically concerned that we may have more profit also on gold. Because of once those prices began to rise, both sides will be cashing out. Do you understand? So let me go to my note. It's becoming interesting. I don't know if I can extend your time. It's based on your permission anyway. So now, another reason is this. Another one I also understand, some of us may not be in the market, but let me just give to you for information purpose, is this treasury bill. So when the bond yield, rises, so the gold price is also going to like drop. The reason is that gold is a non-heeded asset, meaning it doesn't pay interest. So it's only the value. If you have asset on gold, it's not that you're going to get interest, because it's not an investment you invest to a company to receive interest. It's an asset class that can rise or fall. So it means when yield on safe asset like US Treasury bill rise, so investors shift their money away. So that's another thing. But this impact is not too strong because it's like a long-lasting impact. So when there are more interest from money market, which is Treasury bill, most investors can move their money from asset class to that bond where they can make more money. But if the bond started falling, then they will move it back to gold. Gold is technically used for hedging for big investors. Then you now, no more different between you and them. You just have to find a way to apply it on your own level. That's the only thing that is more important to you. So if you think that you can't do it, then you can't do it. So look at the area that concerns us here. It's here, the stock market, the US 500 goes together with the price of gold. And the cryptocurrency also go together with the price of gold. I think here is the area that concerns us more. We are the area that can happen more. Now, they said inverse correlation, sometimes when stock market are strong, gold demand often declined because investors, and when stock market crash, gold price rise. So the reason is that gold is considerable a safe haven asset. So investors float to it during uncertainty or on recession. Now, you know that S&P 500, such as Dow Jones and Nasdaq, then they mirror the price of stock. So when the price is rising, gold price will most likely go weak, and when the price is falling, gold price will most likely go strong. Now look at it here. This is US 500. So now another area where we can maximize the price of gold is here. So it means now that if you want to trade gold, again, gold spot or gold hedging, so it can also apply the strategy here. One, aside applying it on any pair that is paid with dollar, you can now apply it on a stock or like on US 500. Now, how will I apply it? It means that when this market began to drop, like if S&P 500 began to drop, the price of gold will rise. So you can use it to hedge it more. Now, like technically, you may most likely put more money in the gold side on a falling asset like a US 500, and when it's rising, you move more of your money back to US 500. So you can use it to mirror your trading. Do you understand?
So please come again, please. I'm confused.
In the stock market, like US 500, which is stock index, it is also mirrored together with the price of gold, apart from dollar. How to know the strength? Because investors use gold as a safe haven. When the US 500 is falling, the price of gold will most likely rise. Why is that? Because investors will move their stock back to gold. Investors will move their stock back to gold. And when the price is rising again, it may weaken gold demand, because those investors that move their price to gold will now move it back to buy the stock.
Okay.
So you ask yourself, how will I apply it? How will I use it to make profit? Fine. You may not necessarily be swapping like that as often as possible, but you can use it to determine the areas you want to make more trade, because since you are hedging with gold, that's what I'm trying to say. So we may consider it, if you want to hedge strongly on the gold side and maximize the gold profit, so we may consider trading more on the asset classes that is backed by the US dollar, and the asset classes that is obviously stock or stock index, like US 30 and US 500. Now, even without that, having like $1,000, then out of your $1,000, you put $700 on derivative, the same platform, and $300 is on hedging. Only that alone, you have capacity of making profit, because in a long run, that $700 you put on gold hedging may hit to $350, $400, or $600. Yeah, within 6 to 7 months or 8 months, it's most likely going to hit that hit. I mean, even as you're trading on other asset classes on your derivative or on your CFD or on your stock with 700, the asset of your gold is also hedging. But what you have to understand is that, one, anytime you are trading, let's say you are trading maybe S&P 500 and it's crashing, coming down for 1 week, go and check the price of gold, it will be rising. So holding that asset class on gold, you will not become a beneficiary, even though all your trade is losing at hitting stop loss, losing. You may see that your gold price, which you are holding on 30% of your asset, has gone to maybe 4%, 40% increase, 50% increase, and stuff like that. So it becomes practically difficult for you to wake up and see that you are out of the market. No, but you can be able to hedge properly and make more profit. Do you understand? Oscar is raising his hand. You can ask a question, Oscar.
Yes, sir. Just a quick one. I just wanted to get the difference between hedging and derivative. You mentioned something about that.
No, derivative is what we are trading now, like buying and selling CFDs and derivative. So it means that we are not taking delivery of, derivative means we are not taking delivery of the asset, rather we are taking the settlement in cash. Like, for example, when you make profit now, nobody's sending you dollar or this, they will only send you the profit into your wallet. You don't understand? But now, when you make profit here on gold, you can ask GFT to send it to you, like this physical gold. I think Cynthia is a lady that like gold chain, gold earring. Then you may ask these guys to send you the physical gold directly to you. Now, when they send that gold to you, they are no more sending you the cash value of the gold. Like the $29,000 here won't be sent to you. Rather, the 300 gram of gold will now be sent to you. Then you can now mint it and use it to do, because it comes in bars. It's not even in, it comes as a gold bar, a bar. So then you cannot use it to do your watches, jewelries, and stuff like that. Because now that's the difference between derivative and non-derivative. Like the current one is that the value is derived in cash, and you can get settlement in cash instead of taking delivery. Do you understand? So basically, the whole world is on derivative because most of these assets, people does not take delivery. They only want cash. Do you understand?
It's becoming quite confusing.
Don't worry.
I have a question.
You're moving to advanced level, so take it one stage to another.
I have a question, sir.
Okay.
For some of us who are beginning to lose interest on currencies, it's really good. Now, for instance, now assuming I'm trading gold on CFD, and I have this system in place. So assuming I enter a position and I'm losing the trade on gold, for instance, I'm on negative. Wouldn't it affect the gold the physical value of gold that I'm hedging? That will make me lose in two places now.
Perfect question. Yes. So this is gold now, and this is gold CFD. So you know that yesterday the price was here. We talk about that it will keep rising. So as you're holding it on gold, and the price has gone up here, the value will still go up here on spot. Do you understand? As you're holding it on gold on CFD, I would like to be hearing your voice, to be honest. So as you're holding it here, and the price has gone up, then if you check the price of gold spot, the price will also go up here. Do you understand? Now, if you watch the chart on CFD and the price has dropped, for example, drop like this, then after a while, like 2 or 3 days, check the spot market, which you are holding. The price is also most likely going to drop because of they all go together. The difference between this price here and the price on derivative here is that derivative has to do with margin. Do you understand? The derivative instrument has to do with margin. Do you understand? And while the spot market just has to do with the spot price without margin. So on derivative, you'll be seeing each of the movement goes to $2,794.92. So this cent is the marginal point. While on the spot, it does not count on margin, but the value we see add. So let's say now, me and you, we are on the same class. I trade mostly oil and the gold spot. I don't necessarily trade on gold, but because of this new innovation now, I'm trying to know whether I can now I add my portfolio to gold, oil, like gold CFD, gold spot, and oil because of this new innovation. So what I'll be doing is this. I will now find a way, if the gold price is down like this, I don't know whether you're listening to me or you're still not there. So if the gold price is down like this, like maybe the price come down like this, I can buy both spot and CFD. Do you understand?
Yes.
So I can buy both spot and CFD at a low price, and the value of them will be going up. But look at one interesting thing about it. The CFD may drop very sharply to 400 pips, but the spot will not drop like that.
Why is that, sir? Why?
Because of the spot is not done on margin. while CFD is done on margin. So like this 66 cent here is about 77 pips. So let's say now you are using 1 pip $10, and this one dropped to this 77 pips dropped down. That would be $770. Then assuming the price added, that would be also additional $770 added. So now the margins picked every single movement on gold, while the spot does not pick like that. So kind of it picks on a standard price without reflecting the margins.
Because of leverage.
Yeah, of course, now because leverage also correlates with margin. So on the spot, there's no margin here. Now, for example, gold from $39 to $100, that'd be how many pips? That'd be almost like $50 to $100 would be like 5,000 people, right? Yeah, 5,000 people. 39, that would be almost like 839,000 people on gold. For example, you know that 1 gram of gold now is $100. So now, if you check how many cents that make up that thing, that's about 800 something thousand pips, right? Am I correct? So now, if you're holding it maybe 1 pip, $1, so you must have made about 800 something $1,000. But now, if you're holding it on the margin, the profit will not be as much like that, because imagine, so if you're holding it on the spot, the profit will not be like that because of the risk on the spot is low, and it does not capture all the movement, and it's not based on leverage. So what you will gain is the entire value of the gold on the spot market. Why what you will gain on derivative is the entire movement. Any single cent there is calculated and is taken into account for on derivative and spot and the CFD.
You know, it's just today that I sorry, please you guys should not laugh at me. But just today I just knew that there's a difference between sports and CFD. I'm telling you. Please don't laugh at me.
No, I'm not laughing at you. I'm not trying to be excited that you're learning something new. So we are trying to take it to the next level anyway. So some of these things are easy when you practicalize it. So I will encourage you guys to register. Let us register within 5 minutes, then we can close. And by that time, if you have a question, you can be asking me. You don't need to make any whatever account, just to familiarize yourself with the system for the sake of information. Like you don't need to make any deposit or withdraw or payment or stuff like that. Do you understand? Any further question? So are we doing that? Let me be sure if we are doing it before I continue.
So we need the link again, sir.
Oh.
Yeah.
Check the chart. We want to make you guys strong traders where you can diversify on different investments. Understand how this is work. We don't want anybody coming through us to have liquidations, because we don't blow accounts. So you guys shouldn't blow account. It's all these metrics we are putting in place that is making us difficult to blow account, apart from regular stop loss we put here. But it's actually good for you to have access to hedging. It's very, very good. Then you know that you can trade your own account. It's not that you are putting on here. You trade your own account now. So you can trade your own account with the brokers we are using, and hedge part of it with gold market. That's if you want. If you don't want, you can put all of them there. But hedging is good. It's very, very good. It's very good, especially if you're putting big money. Then you can still use the 100% automated platform from GFT Alpha. Then on the and start making money from the values.
So, Mr. Uche, so
Yeah.
for us to use this system, does it mean that we must have account to GFT? There's no other, we cannot connect it to another broker, abi?
There's no broker that's offering it at the moment. Does your broker offer it?
Okay.
Yeah, so these are new innovations. Brokers are going ahead of others. No broker, if your broker offers it, fine, because we are the first to offer it now, unless if tomorrow it become popular, other brokers will start integrating it on their platform, like try to integrate spot. Because I can tell you, this is how big institutions does. They have all the platform that is more powerful than MT4. They can use it to swap at the same time, the same minute, very easy.
Sabis, I have a question. I know I'm dragging you back. You see your GFT app, that's the dashboard. I see your true value. I think that's the money available, and the gold value. Why is it less? Sorry. Why is the gold value like 25,000, 29,000, and the US value 110?
This value here, this one is only value of gold hedge on exchange, different exchange on the spot. That's 300 grams. So technically, a gram is about either maybe $100. Okay, let's say about $98 as of this morning. So multiply that $98 times 300, then it will give you approximately this price. So it goes up and down. So yesterday it was 30,000 plus.
So is that equivalent to the amount of money you have with them?
Yes,
Or
yeah, it's equivalent to, it's equivalent to the amount of money here. So if you check on website, maybe Bloomberg or another forecast site, check the price of gold on spot, you see that it will be the same price. Maybe different may just be 1%. It will not be too much, it will be the same price.
the same price?
Okay.
Sorry, the same price with the 110?
Yeah. Yeah, check the gram of gold check the price of gold on other site that shows the real data, like current price of gold today. You see that it will be around no, this 110 is the value of the trade on the MT5.
Yeah, so my question is, when you said your account is hedged to gold, is it that a certain percentage of the account is hedged to gold? Or
Yes. A certain percentage of account is hedged on gold, and a certain percentage of account is here. So total value is this one.
yes.
Yeah.
And the amount that is hedged is 29,000.
Perfect. Yeah.
Okay, so even if you're gonna lose, you're not gonna lose, you're still gonna retain the 29,000.
Yes. I assuming I'm careless here.
Yeah.
And lost all my money on derivative, then I have a hedging. So if it's on the obvious market that lost more, so that now the gold price now go up, so I may end up having more than 39,000 because the price of gold has gone up, despite this loss.
Okay.
And so I may be having 40,000 here. That's hedging.
Another thing for the sports trading, is there also on exchange? I'm just asking outside of this scope.
Yeah, most spot are on or are done on exchange. So most of this MT5 doesn't have exchange. Check it. MT5 don't have exchange option where you can buy at a spot. Or that everything is on CFD or margin.
Yeah, okay.
So what we're trying to do is that we want to diversify to other markets. Do you understand? To integrate them together, which is more better than to put all the money in just this, because that's one of the reasons why people become more vulnerable in terms of losses.
Okay.
So that's what we want to achieve.
Okay. Thank you.
Which is a good idea. I don't think it's a bad idea. And you asked a very smart question. Are we going, because we have to round up as soon as possible?
Yes, sir. So this book that you're sending now, someone that registered before.